All right, we are live now. What is up? Hello, everybody. Say hi in the chat so I can just have some comfort that there are people out there. As we jump in, hey, Terry. Hey, Misty. Hey, T. Dwayne. Oh, okay. Awesome. What's up? Question for you. Last night, there were northern lights all across the US. And I kid you not, I was like just crawling into bed, and my wife was like, "You have got to come outside and look at this." And I crawled out kicking and screaming, and it was super cool. Did anybody see Northern Lights last night? And they're supposed to be better tonight as well, I believe. Yes? Okay, Lisa and Leslie? Cool. Hopefully you guys got some good pictures of that. Really neat. My mom told me that they were actually coming in stronger tonight, so keep an eye out for that, Misty. Um, I'm going to share my screen here, and we're going to jump into a session around when accuracy is enough and talking a little bit about advisory, materiality, and all of those fun things. All right, you should be able to see my screen now. I'm going to try to pay attention to the chat. However, feel free to ask a question in the Q&A. The Q&A section is separate from the chat on the right-hand side of your screen. And if you pop Q&A in there, I will see that. We will handle it as we walk through the session. And you will get CPE through this session via earmark after the session is completed. So we're going to talk through when accuracy is enough. Before I jump into that, if I haven't had a chance to meet you yet, my name is Roman Villard. I am a CPA, a reformed CPA. I'm recovering from my true public accounting days where I spent 7 years in audit. I did sales and business development for 4 years at two different firms and started my own firm about 3.5 years ago. And we are a CAS practice, predominantly outsourced accounting, bookkeeping through fractional CFO, and we also have a data department as well. So data science team working on automations, AI agent building, and fun things like that. I also have had the opportunity to serve as an advisor to Intuit, Gusto, Mercury, CPA.com, and a few other tech companies. I've been a husband 10 years and a dad for 4 years with 3 kids under 4.5. And I will publicly claim that these lists of about me are in no particular order of importance to me because the kids and the wife are definitely a higher priority than the work. Okay, let's jump into it. Again, use the Q&A if anything comes up to mind as we walk through this. Would love to have a conversation. Okay, so a few months posted something on LinkedIn that 54,000 people seem to care about. And it was really this concept of you need to quit reconciling to the penny. Accountants don't have an accuracy problem, they have a precision problem. And so what tends to happen is accountants, we've been trained that, this precision in numbers, this zero balancing balance sheet is like what we have. Yes, you need to have a balancing balance sheet. Let's not ignore that. But um, we're trying to like identify where this $2 issue is coming from. And so I shared some thoughts on that. Now, here's the problem. Here's what that led to is the strong opinions that came through it. So we had a lot of people say, "Hey, this is great." Some people like David say, "Hey, it's fine if you made a $1 million error one way and $999,000 the other way," kind of sarcastically calling me out there. Justine said, "Yeah, there's a lot of gray in accounting. It's not just black and white." And then, some folks just calling me out, just saying like, "This is just straight up bad advice." I'll let you be the judge of whether or not this is bad advice, but let's have a conversation about it. This is gold. First step is round to the dollar. I don't even want to see cents during my work. Kind of missed the point of like, this isn't about the cents. Um, and talking about materiality thresholds is where most accounting teams get trapped. I've seen month-end closes drag on for days because someone found a $47 discrepancy in petty cash on $1 million revenue recognition. This is crazy. But then the king comment from Farzana said, clients want clarity, not perfection. Focusing on what's useful instead of what's flawless can make a huge difference in both impact and efficiency. So that's what we're going to focus on today is how do we like focus on the things that matter for our clients? And then we're going to go into a deeper dive in advisory around like how do we actually implement more tactical reality thresholds for our team to be thinking about. Now, before I get that, there's one other comment, and it was a meme, and I know Financial Sense likes their memes, but I had to pull this up. One of the comments on that post was this great meme of on the left hand side, you've got people who don't maybe necessarily fully understand the accounting side, and they're like, just round it, it'll be fine. And then you got the stereotypical account that's like, we must drop everything and work nights and weekends to make this reconcile. Like that typically see in the accounting world. And then you got the Jedi on the right-hand side that's like, "Hey, this is accurate enough. It meets our objectives of helping us to interpret financial statements. Let's plug it and move on. Let's focus on the more important things." So I really like this meme. It's kind of funny to me. You could check out more of those comments on the post 2 months ago. I'm sure it'd be easy to dig up looking at my LinkedIn profile. Okay, so I want to talk for a second about the Great Wall of China. The Great Wall of China is a fascinating study to me because it took 2,300 years to build. It spans over 13,000 miles. Estimated cost was in the hundreds of billions of dollars over centuries. The human labor component to it was massive. It took hordes and hordes of people from across China to get this done. And the goal of this wall was to fortify frontier from invaders to their north. Now, what would happen century over century is that emperors would look at the progress of this wall and they would aim to not only fortify the northern frontier, but it really become this like status symbol. This, hey, how much of the wall did you complete? Well, my wall's bigger, and we can all relate to some of that narrative we hear in the public sphere today. However, what's interesting is that over the course of 2,300 years and 13,000 miles, it didn't really work to actually fortify the northern frontier. Like invaders were coming in and around and over this wall at various points because it was built through these mountainous regions, and there may have been some like physical or mental deterrent to looking at the wall and maybe not wanting to go through it, but anybody who really had any willingness to like want to try to get through this wall could pretty easily do it. But it looks super cool. So take a look at like some history of that. What I find is interesting is that we as accountants we tend to spend so much of our time trying to build this wall, trying to reconcile these accounts to the penny when in reality, like our clients don't really care a whole lot about that. And I'm going to share some examples and stories about that journey. But I want to talk a little bit about why the majority of CAD services, outsourced accounting has become kind of our great wall. So there's a disproportionate level of effort versus impact. So as an accountant, like we want to drive accuracy, want to drive precision in our reconciliations and the work that we provide to the clients and the balance sheets, the P&Ls that we send. But oftentimes, like, the time and effort and labor that it takes to drive that perfection often isn't actually what's driving that strategic decision making. Similar to the wall, it gave the impression of a comprehensive barrier, but it actually drove limited incremental value. The next thing is that the emperors who were building this wall were psychologically satisfied by seeing this wall, and they were focusing on what could be controlled or seen in the construction of that wall, right? Similarly to accounting teams, we are involved in the weeds of accounting. We're involved in the reconciliations on a day in and day out basis, and so that is what we tend to focus on. Those small discrepancies that pop up, those small variances that come in through payment processors, and so we're digging into those. And not to say that that's a bad use of time, because those things can certainly build up over time. We just need to have the right rhythms and controls to be able to manage those well and actually focus on the things on a material basis that impact the clients. There's also the opportunity cost component. So, how much time, labor, capital is spent on those small things relative to the things that are actually driving value for our clients? Do we actually know what's driving value for our clients? Like that's a really big starting point, right? For our clients, we need to know what those value drivers are. And so during that onboarding process, we need to be asking those questions. We need to understand What is it that you are actually hiring us for? What pain are we solving? What value are we driving beyond just the accomplishing of the books for compliance purposes? And this is why I say the majority of CAS has become our Great Wall, because oftentimes for tax purposes, for compliance-based bookkeeping purposes, you do need that high level accuracy. If you're providing a CAS service, you still need the accuracy. However, it's done through the lens of what value is being driven to the client. Are they trying to navigate a fundraise, an equity fundraise with investors? Are they trying to acquire a business? By far and large, I think they're trying to grow. And so, how are we helping provide the numbers, the detail, the data to help them do that? Lastly, the Great Wall of China became more of a national symbol than a functioning defense from the invaders in the north, and I think to the stakeholders inside of the firm who are looking at this like really well put together balance sheet with a killer chart of accounts, organization that looks really clean. Like that is great for us accountants. We tend to really like that. However, that clean chart of accounts may not actually yield the business running better on the other side if they're not actually understanding how to interpret those financials. And so, you know, Shannon here asks, like, how can we determine the opportunity cost of certain clients? So a big component here, Shannon, for the opportunity cost of spending time with clients, like for us at Full Send, we do track time, and we actually track time at the item level, like how much time we're spending in AR, in AP, in financial reporting. And so what I want to do is actually determine how much time is being spent in analysis of numbers and analysis of value to the client versus the actual reconciliation of and block building for the client. So how much of our time are we spending actually, sending invoices, managing collections, and we're gonna of course have a level, a threshold that makes sense to us. But when I see that client A versus client B is way higher in time and their volume is actually similar, I need to dig in there to understand what is my team spending time on that they could be spend timing on elsewhere. And for me, that's an indicator that A, I need to look at maybe a process that is broken with that particular client. Maybe it's a people issue. Maybe I have the wrong person in the wrong seat, or maybe it's a technology issue where I don't have the right tools in place. And so all of those things, those characteristics, is like how I'm helping myself determine what the opportunity cost of spending time in one area versus another area is. Um, Haley asks, do you think AI can be utilized to still offer CAS but not lose so much time focusing on it? Interesting question. I'm not sure that I fully understand, Kaylee. I do believe that AI could be utilized to still offer CAS. I believe that if AI is being utilized within CAS, it needs to be done intentionally so. And what I mean by that is that you still need to understand where your clients are going in order to use AI effectively, because it's all really a function of your prompt engineering, like how good of context are you providing AI to be able to be supportive in the work that you're driving to the client or supportive of the relationship you have with your client? Um, you're going to spend a lot of time on the front end trying to architect new technology coming into your practice, whether it's AI, automation, what have you. You're going to spend some time on the front end, but the idea is that you set up a rhythm to help you drive that relationship and drive the value over time. Okay, so what do business owners care about if it's not your perfect reconciliation? Quick note here, they really don't care about your reconciliation. They don't really care about the month-end close pack. It sad but true. So, what do they care about? If you're running a firm or you're operating a firm or you're managing people, they probably care about a lot of the same things that you do. And it starts with finding calm in chaos, because a lot of what we do for a lot of clients sometimes feels like chaos. So, how do we help our clients find calm? We're going to go through three areas here. One, in a CAS practice, I believe that 98%, if not 100% of our clients have a core focus on cash. And what I don't mean by that is receiving a statement of cash flows every single month because, shocker, they don't know how to read a statement of cash flows unless we sit there and we educate them on that. And I don't think it's the best presentation of cash to begin with. Owners care about, how can I make payroll and also fund growth and not feel the financial stress of not having cash on hand? They care about, how can I put a good process in place to make sure I'm getting my vendors paid, but I'm also collecting cash from my customers on a regular basis, on a consistent interval that I can plan against. Cash is one of those areas that I would 100% focus spending time on if I'm getting into a CAS environment, if I'm planning on offering advisory services to my clients. So, three ways that you can do that is a simple 13-week cash flow forecast. So, understanding their cash inflows and outflows relative to their existing cash balance on hand and continuing to update that over time. That is something that there's a lot of templates out there for. It does require some work and support every single week. However, this increases the number of touch points you have with your client and value that you're driving to them because you're giving them visibility into your books. The second thing that I actually really like, and this is probably a little bit more helpful for product based businesses, but it's also really helpful for professional services businesses who have a cash conversion cycle. So, what I mean by a cash conversion cycle is, for a product based business, your clients are deploying cash to purchase inventory. They are receiving inventory, holding it until it gets ordered, and then they are shipping it out the door when it gets purchased and then ultimately collecting cash on the back end. So, how long is that process from the moment they send cash out to buy the inventory to the moment they actually collect cash for selling that inventory? Similar with professional services, it's, I'm paying my people for work. I am billing or invoicing a client for the work that I'm doing, and then I'm collecting cash on that invoice later. So if it takes one of your clients in the professional services, let's say a marketing agency, if it takes them, you know, 2 weeks or a month cycle that they invoice on, they could be a month behind when they've actually paid their people, and then maybe they collect their cash another 30 days later. That could be up to a 60-day cash conversion cycle that could really create challenges for the client. So think about ways that you can actually advise your clients on a cash usage strategy, how they can um, set up processes in order to manage the flow of cash more intentionally. The cash usage strategy could also be centric around, hey, you've got a fair amount of cash on hand. How can we actually leverage some of this to fuel your personal or professional goals? So that's cash. That's one big area that can help clear some chaos and find some calm for your clients. The next one's profitability. And I don't mean profitability like a profit and loss. Um, we're very accustomed to sending a balance sheet, a profit and loss statement of cash flow to clients. Like I mentioned before, most clients aren't as educated in this space and don't necessarily understand how to formally read a P&L. It is more frequent than I would like that I have to educate people around, what's the difference between revenue and net income, cost of goods sold, and operating expenses. This is not the type of conversation or not the type of profit advisory that I'm talking about. Owners really want to focus in on, what's the profitability of this specific product, of this service, of this particular customer, client, or project. What channels are actually making money for me so I can reinvest in growth? That's the type of advisory that I think about that really lends a high quality or high bar of value back to clients. And so again, cash, profit, these are areas that if you're in a CAS environment, you should be thinking about on a regular basis. In the profit sector, you could use a variety of reporting tools to report on things like margin by segment. Um, when I'm talking about margin by segment, this could be a class, it could be a location, it could be a department, it could be a product, it could be a project. Slicing and dicing in different ways is going to be really helpful. And as all of you accountants know, you need to articulate the accounting, the chart of accounts, the record keeping in a way that allows you to do that. And so the advisory piece of some of this profit advisory actually starts at the very transactional level and then may culminate in some sort of a P&L by product or profitability by project type deliverable. But one thing you want to be thinking about as you architect pricing for this is the advisory along the entire spectrum of your work, not just the deliverable, but what's required from your accounting team to set up the chart of accounts really well in order to get to this type of advisory that provides more granular details for your clients. You could help with pricing strategy. You could help with identifying leverage points of focusing in on one type of project, one type of customer, or one type of channel. Things like this 100% are driving value to our clients. Okay, the next item here, growth. A lot of our clients want to grow. There are very few business owners that I have met that are like, yeah, I'm totally fine just chilling and just collecting a check. Most entrepreneurs, most business owners that I've met, they have this driver in them that they want to continue to grow, whether that's personally, professionally. Maybe it's not necessarily growing top line revenue. Maybe it's growing an impact to a nonprofit partner they have. Maybe it's growing their team and providing more opportunity for their team. There's a lot of levers that you can pull on this growth. But what I don't mean is just a simple month over month change. A lot of systems that we use for reporting tend to um, start with this month over month change report that says, hey, you had $100,000 in revenue last month. You've got $104,000 of revenue this month. Look at that 4% increase. Great job. That doesn't provide a whole lot of advisory to the clients. So owners are trying to figure out like what is helping us move forward sustainably. Some things that you could be thinking about here are pipeline to revenue conversion, looking at their sales process, trying to help them understand how many new deals do they need in order to convert to a revenue target that they are building towards. You could help with their forecast, their financial models, their scenario analysis, headcount planning, benchmarking. There's a lot of different ways that you can start to help a client better understand how to articulate their growth as they move forward. And all of these things should be major points of consideration in your onboarding process with your clients. Okay. So I let me see if there's any questions on that section before I jump to how to help your team find calm. Um, Maria says how to handle when clients expect or want to have access to the whole model. Say about investing back into their business in order to use it themselves. So if a client wants access to your whole process, the secret sauce that makes you you. I think you need to create delineation between what is a firm asset, an asset to your practice that you use internally that's not an asset of the clients, and what are you actually building on behalf of the client or a system that you're integrating for the client's future ownership and their scalability. That there are some degree of risks there, perhaps like if you are creating a process for your client. That's something that I would typically say is client owned. If it's an impactful step to their accounting process, that is likely something that is going to be their property moving forward. Just create very clear delineation in the onboarding phase, in the communication phases with their clients of changing anything that they're currently doing, just to ensure that you have very clear boundaries between like what's yours and the firms, and then what's the clients. So let me jump into how do we think about this through the lens of helping your team find calm. Okay, so as we're thinking through advisory and we're thinking through things like materiality and accuracy and driving value to clients, we need to somewhat redefine what done looks like for our teams. Precision at the end of the day is not going to be the end goal. Relevance is going to be the goal. Relevance to the value that the client desires by nature of hiring us. The close process that we deploy for our clients is, yes, it's for our clients, but our clients really don't care a whole lot about the close process. They care about the insights that come out of it. They care about the accuracy, the material accuracy of the direction their business is going via the close process. So we're trying to close for insight. A big part of what can help redefine done for you in this process is setting materiality. And we're going to do a deep dive on materiality and materiality calculation here, some points of consideration for you here in a few minutes. But start thinking about how we can redefine done for your team in order to drive more relevance to your clients. We want to replace perfection. Accountants historically really equate their ability to be accurate with the value that they're providing. However, Our job isn't necessarily to fix everything, but get to a point where we can focus on what matters and drives value to the client. So, in that, how do we teach our team to drive judgment in the accounting processes, i.e., the accounting or the clients really care about um, maybe they care about their merchant fees for some reason or another, and so we got to make sure that that's really really tight. But they don't care necessarily about the percentage of sales and marketing expense to total revenue. We need to teach our team how to make judgment calls throughout the month, throughout the days, in order to focus on the things that matter. And again, back to onboarding, we need to know specifically what matters to the client in order to help replace some of this perfection with a focus on what's driving that value. Another thing to think about is how are we actually tracking metrics that modify team behavior and and focus on driving value and not necessarily praising the hey, this is perfectly reconciled 100%, because I would far rather a team focus on providing what drives value to a client, how a client has defined that, making them happy, conversationally, make them feel like we've got a great response rate, we are checking the boxes that we said we would in the onboarding process, rather than rewarding the team based on that reconciliation. So, how do we actually reward that velocity and clarity? Some of the metrics that I think about here: one, speed, time to close. Is it taking you 15, 20, 25, 30 days to close the books? Because the faster that you get to a close point in the accounting process, the more quickly you're able to turn value back around to the clients. And we could tell our clients 6 ways to Sunday, it's going to take 10 days to close the books because it takes you 9 days to get us information. But at the end of the day, they're going to want those those results back pretty quickly. So part of this is a educating your client on what to expect from metric standpoint, because there is a bilateral relationship required in order to drive that value more quickly back to the client. So, one thing I hit on earlier is like, what's the work to insights time ratio? If you can granularly track time, which we do in financial sense, we track our time by the client and by the task. You can start to develop a relationship between how much time was spent on the tactical work required to get to the insights versus how much time was actually spent on generating, analyzing, and communicating the insights. I want that relationship to actually trend higher towards insights over time. But that's certainly something that you could think about when you're looking to try to track metrics for your firm. The last thing here is, are you building the right systems around this idea of driving value and focusing on what matters? So do your workflows actually push your team to focus more on the really small, nuanced tasks within the company to drive that precision and the things that may not necessarily drive value to your clients? Or is it driving towards a broader, materially driven or material driven value product to a client? Are your workflows customized to your client to focus on the things that they told you was important to them in the onboarding process? One thing that I think about a lot here is, particularly as we think about tracking metrics and building systems, we want to reduce our time to close. We want to reduce the amount of time that's spent on tactical work and spend more time on the insights. So, how can we spend more time on the automations, on building the dedicated quality control workflows in financial sense? One of the things that I think we should be focusing here is creating a bar for where does quality control come in, at what materiality per client, what are the sensitive accounts, and we're going to talk a little bit more about a system that could help work for that. So I've mentioned a few times like, oh, clients don't care. I actually had a client tell me this in a prospect call about 2 weeks ago. I was walking through a proposal with this client, and this individual had recently bought an e commerce based business. And I was explaining to him in the proposal, here is how we're going to be managing your inventory. And I was walking through the full process. Here's the accrual basis methodology. Here's how we plan to bring in the right systems. And he stopped me mid sentence and he was like, uh, I, I don't mean to be rude. He said this in a much nicer way, but he was like, "I don't care." He was just like, "I don't care." He's like, "I do care. I care about being financially sound, but this is why I hired you. This is why I'm going to work with you because I want you to make the decisions on what should be driving the most value back to me. The methodology on how you get there and what tools you're using is like, it doesn't matter to me. I don't have an educated enough opinion on being able to provide a response back to you on why you should do something else, and this is why I'm hiring you. So it was really astounding to me that this client like actually said that in a call. It took me off guard, but it's one of those things where it was really important to actually hear that and then be able to communicate that back to my team so that they weren't going back to him with a bunch of questions on really small, nuanced things that he would effectively give them the same response for. One of the things that came up at our firm, I don't know, maybe 6 months ago, is I happened to catch an email that was sent to a client, and it was for, like, a $44 expense, uncategorized expense that went to a client, asking for a response on it. And I think it was, like, the 2nd or 3rd request to try to get clarification on what this expense was. I saw the email at that point in time and immediately was like, "We need materiality. Like, why are we asking a client about this $44 expense?" And this is like a $2 million business, mind you. Um, they are hiring us to use our best judgment in a lot of cases to take care of this for them. So if we have a high enough confidence interval to be able to take that expense and categorize it, let's categorize it and move on. And this is this like higher level materiality that I'm thinking about here relative to the other areas of that client that I know they actually care about and are driving importance and value back to them. So I want to spend a little bit of time doing a deep dive on materiality. Now, I spent 7 years working in financial audit. For those of you that have worked in public accounting and an audit before, this should look relatively familiar to you, and it's a principle that I believe that the majority of CAS firms should be using in their practices. So let's go over a quick materiality overview and some definitions here. So overall materiality, like this is the amount that actually matters to a broader client's financial picture on an annualized basis. It is a single threshold that's calculated from a financial driver, revenue, assets, net income, based on the industry. You may choose one of those things. The guideline here for overall materiality is that if an error or misstatement meets or exceeds the overall materiality, it would reasonably change the decisions of owners, investors, or lenders. So, this is like the highest bar in which a number could be modified, erroneous, or miscategorized, and outside parties would be mistakenly making decisions based on that. Tolerable misstatement, which we'll get into a calculation of, is a deviation from over the overall materiality, and it's more of a practical day-to-day working threshold. This is a fraction of the calculated overall materiality. Now, items below this tolerable misstatement are typically judgment driven by team members, and there's rarely escalation required. However, there are a few catches to this, which we will get into here after we walk through how do we calculate overall materiality, and then we'll get into some of those details around the tolerable misstatement. Is this concept familiar to people? Are you all using this in your practices today? I'm very curious to hear um, if anybody's actually deploying materiality calculation. I saw one reaction there. Are you using it? Is it helpful to you? What ways are you thinking about this? Anetta says no, not today. Cool. Only with some accountants. Yeah, it's interesting. A selective materiality. Um, Yeah, interesting. I've been using it, but didn't know what it was called. Yeah, I think there's a lot of folks that will apply very broad, judgment calls on um, decisions for categorizations, journal entries, things like that. This methodology is coming from audit, from financial audit, and so what I'm trying to get to in this materiality calculation is get to a point where I know really like quality certainty that if any of my clients were to undergo a financial audit, they would pass with flying colors. So these calculations are designed to actually be lower than the materiality that would be assessed in a true financial audit by an outside auditor. So a sample overall materiality calculation here would be these percentage ranges for overall revenue. And I would apply this to an overall revenue of annualized revenue, total assets, gross profit, or net income. Now, based on the structure of the business, is it asset intensive? Is it high volume, thin margin? Is it retail COGS, service firms, agencies? I might use different levers here, and honestly, I might calculate all of them to see what drives maybe a more conservative approach to deriving an overall materiality. Once we get to that point, we then will calculate our tolerable misstatement. I'm going to put all this together here in a moment. So, quick guidance on the tolerable misstatement is I'm looking at a range of about 10 to 25% of the overall materiality in order to create that working barrier, that day-to-day misstatement threshold that I want my team to be caring about. Like I mentioned, financial audits here are probably going to be closer to 25 to 50% of the total materiality. For high risk companies that maybe have fraud risk or various complexities or regulatory items on their business, I'm going to use 10% as a starting point and adjust accordingly of that overall materiality. And then for low risk businesses, maybe use a bit of a higher threshold of 25% of the operating or overall materiality for very routine things. Now, what we may do as a firm too is apply different levels of materiality for different areas of the business. And I'm going to get into how to calculate that here and think about it here in a moment. Um, let's pause here for a second because we're swimming in materiality and overall misstatements and percentages. This really brings me back to my audit days, which can be a little bit overwhelming just to think about. We doing okay? Perfect. Good. Um, Okay, let me jump back into the calculation, and then I will wrap by walking through, like, how are we thinking about this for, various client conversations? How are we thinking about this in the onboarding process? How are we calculating it? Things like that. Alright, back to the calculation. So, let's say that one of your clients is a $1 million annualized revenue e-commerce business. Their total materiality, tolerable mis or their overall materiality, which should be the TM up top, should be 0.5% or 1% of total revenue. So for a $1 million business, we're looking at $5,000 or $10,000 of a total transaction that could actually change the business. It would change how somebody views their decision making around the financials. For that tolerable misstatement there at the bottom, which is incorrectly marked here as OM, would be 10 to 25% of that metric. So we could take the low end of the metric, this $5,000, and then calculate the lowest end or the highest risk of 10% here. And then our tolerable misstatement amount is 500 to 1250. Now, you might be thinking to yourself, wow, for $1 million e-commerce business, there's no way I would actually pass on an error in their books that's 400 bucks or 500 bucks. But at the end of the day, we are being hired to apply our judgment. A $400 or $500 transaction is really not going to be moving the needle for $1 million business. However, you may have clients, and I've got clients that care about every penny. And they will come back to you if that $44 expense isn't categorized in the right place. So, this is where the judgment component comes into play. You need to know your clients, you need to understand what's important to them. And so, we want to make sure that we are applying these materiality thresholds to clients based on what's important to them. Have that conversation with them. Now, what I want to make sure is known here is that this materiality is an internal calculation. This is not something that's being shared with the client saying, "Hey, client, we don't care about anything under 500 bucks." Like, that's probably not going to be the type of message that I want to send. Um, Rather, we want to keep the focus on how are we organizing the financials in a way that drives value to the client? How are we focusing on cash? How are we focusing on profitability? How are we focusing on growth? Because ultimately, that $44 expense isn't going to be the question they're asking about in that year end, quarter end, month end review meeting. It's going to be a more theoretical question around their growth and profitability if we have the data point available. So this is an internal metric, and it may be modified based on your the detailed oriented nature of your clients. Um, Another item here when you're applying judgment relative to materiality is that small amounts can still be material if they change the story. So think about related party transactions, high risk categories, regulatory exposure. These are all things that need to be taken into consideration. So if you are setting up a materiality calculation for each of your clients, you may have your overall materiality, your tolerable misstatement. If you have those metrics there, you always need to ensure that your team is aware of the nuance that comes within your clients because those small amounts can be material if they change the story. Document it. Document the choice. Document what benchmarks you were using, the percentages, the rationale, so that you can be consistent in your application, so that you can fall back on a strategy of this was the approach that we took here. You can have some defensibility of that relative to the overall financial picture of the business. Okay, I've got some unanswered questions here. Let me hit on. Yesenia, do you ever run this by the client so they're aware of them, or internal accountant don't come back with questions too? So just kind of hit on that. This is an internal metric. I'm not going to run that by the client because at the end of the day, I do want the clients to understand that I really do care. I care about every dollar. What I don't care about is how much time is being spent on every dollar and not necessarily where it's categorized. If it's in the right place, let's say it's an operating expense and it's like sales and marketing versus entertainment. Okay, that's a tax thing. Don't eat me, tax people. But if it's in one category versus another, I'm not going to care too much about that. But I'm going to make sure that the client's aware of our perspective of how we organizing their books relative to driving value. If their internal accountant has questions on it, I'm not going to come back to them with a response of, oh, it wasn't material. That's not really a good defense. The design here is just to elevate your team's thinking to focus on the important things. Um, If a $400 tolerable misstatement occurs every month, it potentially becomes a 5,000 misstatement by year end. That's correct. That's why we don't want to just sit there and pass on them every single time because small amounts can become material if they change the story. We don't want the story to change because we're continually passing over things that are happening on a routine basis. Routine transactions are a great example of things that you need to make sure are done correctly. And so I don't want to mistake the idea of materiality being we just don't care about those things because that's really not the case. It's elevating your approach to certain transactions and communications with a client in order to focus more on value. Okay, so what materiality doesn't mean, a few items to end on here, is just ignoring everything below the tolerable misstatement. Like, we can't do that because, like it was mentioned by Daniel, if that happens every single month, it could potentially become a really big problem at year end. Materiality also doesn't mean set it and forget it. This needs to be something that's constantly evaluated relative to the risks of your client, the exposures that it has, what they're focused on and care about. We need to be constantly reorienting around what the client perceives to be the most value that you're driving. Again, like I'm coming back to advisory here around just knowing what direction your clients are going. This is not an external figure and may be changed based on client desires. We've got one client that is very detail oriented. He actually articulates his own financial model and he wants to really make sure that everything is super granularly categorized and structured in a way that makes sense to him. And so for him, there's some loose materiality, but I mean, oftentimes we're going back and forth with that client on very small items because that's what he cares about and that's what he's spending time in. So I wouldn't ask specifically about materiality during onboarding. I would ask questions around materiality, meaning, what do you care about? What are items in the financials that really stick out to you on a month to month basis? What line items are your eyes lingering on when we send you financials? That'll help you get a sense as to where that business owner is deriving that value from your work. Carl asks, "Do you feel this adds value for clients?" It should add value to your clients, yes, but not by nature of just having a materiality. It should add value to your clients because your team is now capable or equipped with the mindset to spend more time in other arenas rather than trying to solve that $44 uncategorized expense or that $2 variance in the reconciliation. I don't really care if there's a $2 reconciliation in my rev rec. That problem will work itself out. And that may seem like a non-accountant perspective because obviously we do want it to be accurate, but the value add is taking the bigger picture of what direction is that revenue going and applying it to the situation and direction that the client is going. So yes, I'm very hopeful and truly believe that applying this type of methodology does add value back to the client. Okay, I think I've got most of the questions answered here. Feel free to hop more back into the chat. Um, the other thing here is that materiality doesn't necessarily only apply to dollars. It could also apply to KPI calculations, bank covenants. When you think about materiality through the lens of what are the reports, what are the deliverables that are actually being utilized by your client, by key stakeholders, you need to be delivering these KPIs in a way that makes sense to the clients, that they understand, they can interpret. And so I want to have materiality in terms of how much time are we spending deriving the specificities of these calculations in order to make sure that they are accurate. And if it's not precise by 0.01%, I'm not going to panic about it. And I'm willing to have that conversation, have had that conversation with many bankers of our clients, who may ask detailed questions about the financials. Then when we articulate our approach, when we articulate how we do what we do, it gives them more comfort that their books are handled on a really consistent basis. And so when you think about the risk exposure, materiality, things like that to arenas far beyond dollars, materiality isn't just for auditors. And so I think this is a principle that in a variety of ways can be applied really well to CAS practices. It's one of those things that people have fervent opinions on one way or another. Would love to hear some of your opinions on it. 54,000 accountants saw that post on me saying quit reconciling to the penny. Good, bad, and indifferent. And so I think the intent here is just to create a dialogue around how do we spend time in the right arenas for our clients and focus on the things that matter. And there are so many different directions that we could go here in terms of like coming back to the onboarding process, the questions that we're asking to drive value, our pricing strategy. How do we think about advisory overall? Um, but the intent here was just to create a connection of a concept to explore in your advisory practice. Okay, so we've got about what, a few minutes left here, I think, and happy to answer any additional questions that pop in. Feel free to send me an email. There also is a feedback form at the top of the chat. It says, "What do you think about Roman's session?" Feel free to rate or roast me in that. At the end of the day, any feedback that I receive is good and constructive, and I will learn from it. So please take some time to fill out that form. Reach out to me on LinkedIn. I'm constantly posting on LinkedIn. Again, good, bad, or indifferent. I tell a lot of stories about my day-to-day life and running and firm running and everything in between. So please connect with me on LinkedIn. Any questions or anything that'd be helpful to chat about before we wrap? No. Okay, perfect. We are at 12:30 Mountain Time, and so I need to let you go now. Enjoy the rest of WorkflowCon. Have a great time, and I'll be popping around the various forums and um, outer space as we we chat in free form. See y'all. Thank you.